What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we're looking at some recent comments by Jerome Powell, the chairman of the Federal Reserve. Now, essentially what he said here is, number one, we need more government spending, and number two, the Federal Reserve is not going to increase or decrease its asset purchases. Right now, they're purchasing $80 billion worth of treasuries per month and about $40 billion worth of mortgage-backed securities per month. He said that they were going to keep that up at the current pace until the objectives of price stability and the objective of full employment are met. So we're looking at a couple of things here today to show why Powell is either, number one, a complete idiot and ignorant of the facts, or number two, is just straight up lying. Ready? Let's dive in. All right, guys, the main thing that we are looking at here to prove that either Powell is lying or completely ignorant of the facts, two things that we're looking at are the yield curve and inflation. So why are we going to be looking at these two things? Well, the yield curve, it shows basically, if you're not familiar with the yield curve, it basically just shows how much debt costs or what the interest rate is on debt, depending on what the duration or the term or the length of that debt is. So in normal environments, if your debt is, you're going to have to repay back all that money in 1 year, that is normally going to have a lower interest rate associated with it than debt that is due to be paid back in 20 or 30 years. The main reason for this is simply because there is a lot more risk associated with holding debt for a longer period of time than a shorter period of time, especially the risk of inflation taking off during that time. So let's take a little bit of a trip back through memory lane and start at 2015. And I have to warn you here, I'm a brilliant artist, and so these graphics that you're about to see here are going to knock you off your seats, and I might even have to start a separate graphics design channel in order to impart my graphic design wisdom to the world. Starting off here with 2015, you're taking a look at this beautiful chart here. You can see on the left side we have the interest rate. At the bottom is going to be 0%, and every line is a 0.5% up until the top there is right around 3%. Then you can see the bottom part of the chart is going to show you how long that debt is going to be held for or issued for. We've got 0 all the way to 30 years here. Now in 2015, this was about what the yield curve looked like. This was before the Federal Reserve really started ramping up, increasing their interest rates, and so the shorter term debt was pretty much at the bottom. It was very close to 0, and then as you go out, it was getting up all the way to about 2.5% to 3%. Now again, like I said, this is, as at least directionally, this is normal. Longer term interest rates are normally going to be higher than short-term interest rates. Now we know that this was right about the time when the Federal Reserve had been saying, hey, at some point we're going to have to taper back, cut out this quantitative easing, we're going to have to start raising interest rates, we're going to have to start letting this balance sheet bleed off. So this was before that had started to happen. Well, fast forward 3 years to 2018, and this is what the yield curve looked like at this point. The bottom end of the yield curve started at around 2.5%, and so you can see here it was actually pretty flat. Interest rates didn't go up much past that. It was a pretty flat curve, meaning that pretty much wherever you were on, how far or how long your debt was going to last, that interest rate was going to be pretty similar. Now, you probably remember what happened at the end of the year 2018 when the markets started to crash, credit markets started to rupture, and weird things started to happen, and the Federal Reserve, Powell stepped in and said, you know what? We can't raise rates and we can't keep on doing this. We are going to drop rates. Well, fast forward a little bit further into about August, September of 2019, and this is now what the yield curve looks like, which if you notice, the curve is going the wrong way. This is what's called an inverted yield curve, where you have longer term debt which has a lower interest rate than shorter term debt. Now, just in case you are not familiar with the history of the inverted yield curve, it is one of the most reliable indicators, leading indicators for a recession. In fact, if you look at the 10-year and the 2-year Treasury spread, for as long as that data has been published by the Federal Reserve, which is since 1976, it has predicted every single recession with no false positives. Now, you have to remember, COVID didn't come onto the scene seen until late December in China, and people started talking about it over here in the States in January of 2020. So this was far before any news or any possibility or any thinking of any sort of pandemic had happened. There were already starting to show signs of extreme weakness and potential dangers coming up in the economy through the inverted yield curve. Now, fast forward to the beginning of 2020. Again, this was before any massive spending. This was before any government attention on COVID. And you can see this is what the yield curve looked like, and it was still inverted. But the Federal Reserve had continued to lower interest rates along the way. So it was pushing down the entire yield curve, but it had stayed inverted. Now, once we had the extreme spike in the Federal Reserve's balance sheet, all the government spending came out and all the emergency measures were rolled out. This is what the yield curve looked like. At that point, we see that the shortest term rates were pegged at 0 and rates slowly climbed from there. Now, we were no longer inverted here at this point in 2020. However, rates across the board were staying extremely low. And this is one of the most potent tools that the Federal Reserve has in its bucket, is pegging interest rates to 0. But what you might have noticed throughout this entire time is that really the only interest rate that the Federal Reserve controls is the shortest term. It's that federal funds rate. The rest of the yield curve is really just a reaction in the private sector by private actors in response to that shortest term debt being held at 0. Fast forward to the present, and you can see here that the Federal Reserve is losing control of the yield curve. In fact, this is the steepest that the yield curve has been in about 4, maybe 5 years. While the short-term interest rates have still not moved, the longer-term interest rates are still heading higher. And this is specifically because the Federal Reserve doesn't directly control those longer-term interest rates. There's free market influence here. And so the free market has slowly been looking around and has been noticing something that has been causing them to say, we want a higher interest rate on our debt, or else we're not willing to be the owners of that debt. We're not going to want to lend money if we're not going to be able to get a higher interest rate on it. What could that be? What could the free market be seeing here that's causing the free market to demand higher interest rates? You guessed it, inflation. Now, just in case, I want to take a little bit of a step back here and address something, because a lot of people look at a conversation like this happening and say, that could never happen, or maybe not that could never happen, but that wouldn't happen for a long time. Rates can't really spike that fast. Inflation's not really getting going. We haven't had inflation for a long time. The Federal Reserve has been printing a lot of money. The Bank of Japan has done this for years. Hold up here. I haven't shown you anything yet that is projected. All I'm showing you is what's actually currently happening. So when you say yield curve steepening can't get out of control, it's already moving that direction. We're going to look at a couple charts here. When some people say, oh, there's no inflation, there's been no inflation, there can be no inflation, prices aren't going up, they are. Let's take a look at the actual data. How about lumber? Lumber has tripled in the last year. Or copper, which is up 48% in the last year. How about nickel? Nickel is up about 70% in the last year. How about zinc? Zinc is up about 50% in the last year. How about aluminum, which is up about 30% in the last year? How about cattle, which is up about 50% from its bottom in March? Or sugar, which is up about 55%? Or soybeans, which is up almost 60% in the last year? Or corn, which is up almost 30% in the last year? Or wheat, which is up about 20% in the last year? Or natural gas, which is up about 70% in the last year? Or oil, which is up about 12% in just the last month. So inflation isn't some specter, some far off ghost that we need to be afraid of at some abstract point in the future. Inflation is happening right now. I'm not even talking about asset prices. Obviously, everybody can look around and see there's been a fantastic increase in the price of assets. But these are the things that people buy are made from. This is the raw materials. This is agriculture. This is commodities. And so where free actors can, they're looking around and they're saying, hey, we need to demand a higher interest rate on our debt, or else we're just going to be losing money, right? When you adjust the interest rate for inflation, that real interest rate becomes 0. And so Anybody who can do the math and who cares about a profit will look at that and say, I don't want to do that. So if I'm going to lend you money, I have to lend it at a higher interest rate. Even mortgages. Obviously, mortgage rates have been dropping for a while, but within the last month or two, it looks like the mortgage rates might have bottomed here and look like they might be poised for a move up in the other direction. Now, we know this is currently what the yield curve looks like, but if things go the way they're going and don't stop, and the Federal Reserve does not increase its asset purchases, the yield curve will soon look like this. And having short-term interest rates held near or at zero will do nothing for the rest of the yield curve, and debt and interest rates across the board are going to start to spike. Now, here's the problem. I've said it many times before, and I'll say it many times again. The economy and government are both insolvent in the face of rising interest rates. We don't know exactly where the line in the sand is drawn here, but we do know that at some point, interest rates getting too high will cause the economy to grind to a halt. Both corporations and governments are so loaded up with debt that the only way to continue servicing that debt is by getting new debt in order to pay off that old debt. And if the new debt you're getting to pay off the old debt costs more, has a higher interest rate on it, that means that at some point, if that cost gets too high, you won't be able to pay it anymore. Now, there's people smarter than me out there that say the line in the sand is probably somewhere around the 10-year being at 2%. Right now, it's about 1.1%, so we could have a little bit of room to go. But the fact remains that as inflation continues to tick higher, interest rates especially towards the further end of the curve, will start to increase along with it. Which means that the only thing that the Federal Reserve can do at that point is to step in with full-blown yield curve control, which means that instead of just buying shorter term debt, instead of just pegging that shortest term rates to zero, they're going to have to step in and start buying longer term, longer dated debt, and they're going to have to increase their asset purchases. The $80 billion per month that they're currently spending on buying treasuries is not going to be enough because there won't be any other private free actors out there buying up that debt. If we look at this chart and see that rates are pegged at a very low interest rate here in order to keep the government and the economy solvent, no free actor is going to be the one stepping in to lend that money. That money is all going to be coming from the Federal Reserve, because if inflation is high, you're not going to lend your money at that low interest rate because debt then turns into a guaranteed loss. And so $80 billion a month is nowhere near the amount necessary. They're going to have to drastically increase their debt purchases. And that doesn't just include treasuries, that includes other things like mortgage-backed securities as well. Now, I don't think the people at the Federal Reserve are idiots, but I do think they're highly divorced from reality. And also, I don't think that Powell is outright lying here. I just think that, again, so divorced from reality, he has no idea what's coming down the pike. The Federal Reserve has, for a very long time, been very reactive. They've really never been proactive. And so we're probably going to continue to see a steepening of the yield curve here, where any free market debt will start to go up and up and up in terms of its interest rate until something breaks in the credit markets. Something's going to happen. Federal Reserve's going to have to step in and implement full yield curve control and drastically increase their asset purchases. Now, while I personally don't like to invest in bonds whatsoever just because of all of this and because the interest rates you're getting on them are virtually guaranteed to be less than inflation, meaning that in real terms, you're losing purchasing power by investing in treasuries or pretty much in any bonds for that matter. Now, while I still think that is true, one thing that I do like to do is speculate by trading off of these moves, because if interest rates do continue to go up here and then all of a sudden have to get smashed back down by the Fed, you can see some significant moves in derivatives of bonds, like even just ETFs that like TLT or BND, some of these large ETFs that hold a lot of bonds in them. And so if interest rates are going up, that means the bond prices are going down because of the inverse relationship. And so betting on a short-term down move in some of these ETFs and then a subsequent rally following that down move is potentially a way to make some good money, especially if you're using derivatives on those funds like options. Now, I don't recommend the trading of options, but if you're interested in learning how to use them, simply because instead of deploying a large amount of capital to get, let's say, a 10% move, you could deploy 10% of that capital to get a leverage move on the amount of money that you're trading. Your risk stays the same or even less because you're, willing to lose everything you put in, but what you're putting in is such a much smaller amount compared to if you were just trading the fund outright. So if you're interested in learning more about trading options, whether you've never done it before and you're a beginner and you want to learn all the fundamentals, I've got a course for you linked in the description below. Or if you already know and understand the fundamentals of options trading, but you really want to take it to the next level and start to be able to implement some of the more advanced strategies like iron condors and calendar spreads, things like that, go ahead and check out my advanced course listed again in the description below. And finally, if you haven't already signed up for my new memberships through YouTube here, I've recently launched a membership. It's $25 per month, and we're going to be doing a live stream Q&A every single month. Very small group, so it's going to be very conversational. So I'm really excited for all of you who have joined already. There's a join button next to the subscribe button beneath my videos. And if you don't see it there, you can always join through the link that is in the description of the videos. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.